Today, we're backtesting the Golden Cross, one of the most widely quoted technical signals in financial media. We'll compare it to simply buying and holding the S&P 500 from 1999 through 2024. This is backtested strategies, real tests, hard data, no spin. If you want to see how trading strategies behave in rigorous backtests using professional tools and data, you're in the right place. For this backtest, we're using daily bars on SPY from a professional data provider with prices adjusted for splits, dividends, and other capital actions. A 200-day simple moving average is used as the long-term trend anchor, and a 50-day simple moving average is used as the shorter-term trend filter. This is the classic Golden Cross 50 and 200-day moving average setup. A Golden Cross occurs when the 50-day SMA crosses above the 200-day SMA, and a death cross occurs when the 50-day SMA crosses back below the 200-day SMA. This Golden Cross versus death cross strategy buys SPY when a Golden Cross occurs and remains fully invested until the death cross. At that point, it sells the entire position and moves 100% to cash. Each strategy starts with $10,000 of capital. The evaluation window runs from the start of 1999 through the end of 2024 using whole calendar years. That's more than a quarter century of data, spanning multiple bear markets, many powerful bull runs, and some sharp volatility shocks along the way. Signals are evaluated using the closing price, and all trades execute at the next day's open, so there's no look ahead. Every trade pays 1 basis point per side in costs, one to buy and one to sell. When the system is in cash, cash earns 0%. We do not model taxes, advisory fees, platform fees, or financing costs. And our benchmark is straightforward. We buy SPY once and just hold it through the end of the test using the same backtest settings. So, does the Golden Cross trading strategy meaningfully improve results versus our buy and hold benchmark in this backtest? Let's get into the numbers. But first, a quick disclaimer. This video is for educational purposes only. It is not investment advice or a recommendation to buy, sell, or hold any investment. Any performance shown is hypothetical and based on historical data and specific assumptions, and past results are not indicative of future outcomes. Please pause now to read the full disclaimer on screen. All right, let's have a look at the scorecard and walk through the head-to-head performance metrics. We'll go section by section in the same order you see on screen. Section 1, Exposure. For the Golden Cross, time in the market is 74%. That works out to 0.5 trades per year, and the win rate is 75%. For buy and hold, time in the market is by definition 100%. Trades per year and win rate are not meaningful because the position is held continuously. Section 2, Risk. For the Golden Cross, volatility is 13.4%, with a max drawdown of minus 33.6%. The Sharpe and Kalmar ratios are 0.7 and 0.3 respectively. For buy and hold, volatility is 19.3% with a max drawdown of minus 55.2%. The Sharpe and Kalmar ratios are 0.5 and 0.1. Section 3, Payoff. For the Golden Cross, the compound annual growth rate is 8.4%, and ending capital is $81,389. For buy and hold, the growth rate is 8.1%, and ending capital is $75,520. So with this Golden Cross trading strategy, you're not trading often. You're making a small number of big regime decisions. In exchange, you get similar long-run return, a much smoother ride, and roughly a quarter of the sample spent in cash instead of in SPY. However, the details depend heavily on which decade you're in, and that's where things get interesting. Now that you've seen the scorecard, let's look at how those metrics play out along the equity curve. The gold line is the Golden Cross, and the dark line is buy and hold. When the system is long, the Golden Cross line tracks the market. When the system is in cash, that line goes flat while buy and hold keeps moving. In the early 2000s, through the dot-com bust and then the global financial crisis, you can see the Golden Cross stepping out of the way while the buy and hold line carves deep troughs. By the end of that period, the Golden Cross has turned a very rough decade for stocks into a steadily rising curve. From the post-crisis years through the long bull market that follows, the picture flips. The buy and hold line climbs more aggressively, while the golden cross line rises more slowly and spends less time fully exposed. The drawdowns are still shallower and shorter for the golden cross. But you can see the cost of those defensive exits. Each time the system steps aside and then comes back in later, the buy and hold curve catches up a little more, and the gap between the two lines narrows. In the most recent years around the COVID crash and the sharp rebound that follows, the visual pattern matches what you'd expect from a slow trend rule. The golden cross line drops with the market, then flattens while buy and hold snaps back in a V-shaped recovery, and only later reconnects with the uptrend. Taken together, the equity curves show the core personality of the golden cross. It behaves like crisis insurance in crash-heavy, choppy regimes, and gives up meaningful upside in long, strong bull markets and in fast rebounds where staying fully invested was the better answer. To recap, we've reviewed the head-to-head metrics on the scorecard, and we've walked the equity curves, highlighting the personality of the golden cross along the way. Now let's take a step back and talk about what this strategy is actually doing for you. Here's what it buys you. Over the entire 1999 to 2024 span, the golden cross and buy and hold land in roughly the same place on return, with a small edge to the golden cross. Where the strategy really shows up is in the path to get there. The crashes are smaller and less frequent, the ride is smoother, and you spend less time fully exposed to equities. You saw this most clearly in the first decade. In the crash-heavy 2000s, buy and hold turned into a lost decade, while the golden cross converted the same period into a steadily rising curve. That's the core value proposition. It takes really ugly markets and makes them survivable, without abandoning the equity risk premium. Here's the trade-off you are choosing. The cost of that protection shows up in stronger regimes. In the long post-crisis bull run, and again in the recent years around COVID, buy and hold simply pulls ahead. Every time the golden cross steps aside during a correction, then comes back in after the rebound has already started, the gap between the two strategies narrows. So, the trade-off is very clear. You are trading some bull market upside for smaller and shorter deep drawdowns. Given all of that, how should you think about using a trading strategy like this? It makes the most sense if your primary objective is to stay in equities, but avoid the very deepest drawdowns. And you're willing to give up part of the upside in long, uninterrupted bull markets to get that. But if your objective is to capture every bit of equity upside, regardless of drawdown, then plain buy and hold is still the cleaner choice. At Backtested Strategies, we always include a short bonus section at the end of our videos for viewers who want a tuned variant of the same idea. So thanks for sticking around. For this golden cross strategy, we ran a parameter sweep across the two simple moving average lengths. Across those tests, one configuration stood out in this historical window. We'll show the results right now, and to receive the tuned parameter pack for this test, go to backtestedstrategies.com/golden. The link is also posted in the video description. We'll go section by section using the same grouping as the scorecard. Section 1, Exposure. For the standard version, time in the market is 74% with 0.5 trades per year and a 75% win rate. In the tuned version, time in the market stays at 74%, trades per year increases to 1.1, and win rate is 57.1%. So the tuned version trades more frequently with a meaningfully lower win rate. Section 2, Risk. For the standard version, volatility is 13.4% with a max drawdown of -33.6%. The Sharpe and Kalmar ratios are 0.7 and 0.3, respectively. For the tuned version, volatility is 12.1% with a max drawdown of -18.9%. The Sharpe and Kalmar ratios are 0.8 and 0.5. So volatility drops, drawdowns improve materially, and the risk metrics step up in this sample. Section 3, Payoff. For the standard version, the compound annual growth rate is 8.4%, and ending capital is $81,389. For the tuned version, the growth rate is 8.7%, and ending capital is $87,761. The takeaway is not that there is a single perfect setting. These results are specific to this SPY history in this set of assumptions. The point is that small systematic changes to the fast and slow moving average lengths can materially shift the balance between return, risk, and trade frequency, even when you keep the overall crossover logic exactly the same. Remember, go to backtestedstrategies.com/golden to get the tuned parameter pack for this backtest. We'll email you the exact moving average settings and implementation notes. Click the video on screen to watch the next backtest, and subscribe if you want more episodes like this. Thanks for watching Backtested Strategies. Real tests, hard data, no spin.